Hi, everybody. This is Peter Schiff. It is Saturday, December 3rd, 2011. Well, the big news on the week was the coordinated central bank rescue of the Eurozone or the euro. At least that's the way it was reported. Major central banks from the Federal Reserve through others reduced their interest rates by 50 basis points on U.S. dollar swaps. What this does is increase the supply of dollars in global circulation. This is billed as a bailout for Europe. I think it was a bailout for the banks. Yes, some of the banks are in Europe, but some of the banks are also here in America. It's not a coincidence that the morning this policy was announced followed the evening where Standard & Poor's came out and downgraded 20 major banks. They did that on Tuesday after the markets closed. On Wednesday, before the markets opened, this bailout was announced. Two of the banks downgraded were Bank of America and Morgan Stanley. And in fact, if you look at the way these stocks were trading, particularly Bank of America, I think it was set to really get hammered. And so I think this was another bank bailout disguised as an economic policy similar to a QE2. The results is not going to be more economic growth. It's not going to change anything really in Europe. The solvency problems that are in Europe still exist, even if you make dollars more plentiful and more cheap. All this is more inflation. It's throwing a lifeline to the banks, but it's strangling the real economy with that same rope. You know, a lot of the criticism of Europe and the ECB, particularly coming out of the United States, is that they're too tight, that the mistake they're making is not following the example set by the Federal Reserve, that they should just have more money printing, more easing. Well, the Federal Reserve set the wrong example. The fact that Europe is resisting going down that road is one thing that you can at least credit them for, and credit Germany and the ECB. So the real success in Europe is going to be measured by their ability not to succumb to political expediency and the pressure from politicians to monetize away these problems. Because when you do that, you get bigger problems, which is exactly what the U.S. is going to find. So to the extent that the ECB, with Germany's help, can remain resolute, then what will happen is, rather than just a bunch of money printing, nations are going to be forced, governments more particularly, are going to be forced to cut government spending because the central bank refuses to monetize that spending instead. That would be a good thing for Europe. That's what we should have done. Unfortunately, we did not do that. So I think the real result of this policy, more inflation, a weaker dollar, even though the dollar didn't drop precipitously as a result of this announcement, it did decline. The price of gold rallied. Gold stocks were up. Oil finished the week above $100 a barrel. I think more signs of inflation are going to continue to be evident. Meanwhile, we also got some big economic news on Friday. We got the much anticipated non-farms payroll numbers. The U.S. economy in the month of November created 120,000 jobs. The bigger number, I think, was the unemployment number that dropped from 9% to 8.6%. That is the lowest rate of unemployment that we've had in a few years. Of course, President Obama is going to take that number and run with it to show that his policies are working. I think what's really going on is Christmas is here, and you've got a lot of temporary hiring. I think people who had part-time jobs were now given full-time jobs, and I think some people that had no jobs at all maybe got temporary jobs associated with the Christmas holiday. And of course, half of the drop in the unemployment rate can be explained by people leaving the labor force. The labor force shrunk. If you look at labor force participation, it dropped from 74.2 to 74. So half of the unemployment rate is simply the result of unemployed people no longer looking for jobs because they're no longer part of the labor force. And of course, a lot of the people that got these jobs, these temporary jobs, or a lot of people who had temporary jobs that now have full-time jobs. Of course, when the holiday season is over in January, I would expect those jobs to disappear. In the meantime, those jobs are not evidencing economic growth. The fact that we hired people to help distribute foreign-made merchandise to American consumers is not economic growth. Remember, we're going to go into debt dramatically over the next month to buy up all this stuff that we've imported. You know, you look at all the pictures we saw of the people in the malls on Black Friday, the people shopping online on Cyber Monday. None of this is economic growth. We're simply spending money that we had to borrow to buy things that we didn't produce. Yes, it temporarily boosts the GDP, but it permanently boosts our debt. And that's really what's going on. The real economic growth is taking place in the countries that are producing all this stuff that we're trampling on each other to buy. Meanwhile, you know, we created these jobs. We created 120,000 new jobs in the service sector. We lost manufacturing jobs in the month of November. So we are creating new consumers, but not new producers. The people have these jobs. They're going to get a paycheck. But what are they going to do with it? They can't buy things made here because we're not making more things. So they take those paychecks and they spend it on imported goods, and it runs up the trade deficit. That's bad for the economy. That subtracts from GDP. That makes a weaker dollar. So all we are doing is exacerbating the very economic imbalances that lie at the heart of our structural problems. We are not solving them with these jobs. The types of jobs that we need to create are precisely the jobs that we're losing. We need more goods-producing jobs, not simply goods-consuming jobs. As far as how the markets reacted to all of this news, you know, on Wednesday, the Dow was up almost 500 points. I think it was 490 points. That was the biggest one-day gain, I think, since early 2009, when you had, you know, the Dow had collapsed and then it had some pretty big rallies. But of course, this huge gain on Wednesday, which was the day of this bank rescue by the Fed and other central banks, it followed the worst Thanksgiving week in the U.S. stock market since 1932. So we certainly had a big sell-off in the market. There were a lot of shorts that for some reason were surprised by this announcement. I don't know why anyone would be surprised by bank bailouts and money printing. That's what we've been doing. That's the playbook. That's the playbook that we're using. So I don't know why people would be surprised, but nonetheless they were. So I think you had a lot of shorts that covered during that rally. It remains to be seen if we're going to have any more substantial gains built on that rally. I would say that it is somewhat of a game changer in the minds of a lot of people, a la QE2, in that the central banks are panicking. They are reacting to the weakness in the stock market, the weakness in the banks, just the way they did in 2009, 2008, with money printing, with bailouts. And so we could have rallies in the stock market. I don't think, you know, it's going to be off to the races, new record highs, but we could be trending higher because of this. But it's not just stocks that are going to go up. It's everything. And if stock prices go up, but commodity prices go up faster, but oil prices go up faster, gold prices go up faster, is anybody benefiting from rising stock prices? Yes, you have more money in the stock market, but you need even more money if you want to spend your dividends or if you want to sell your stocks and buy the things that you really want. See, nobody wants stocks because they want stocks. They want stocks because they want to spend the money they get from their dividends or from the capital gains when they sell their stocks. But if all the things they want to buy are getting more expensive than the things they own, they're actually getting poorer, even as the government and Wall Street try to pretend that they're getting richer. Anyway, have a great weekend, everybody. I will be back next week. And again, don't forget, for more daily updates on what's happening in the economy and the markets, don't forget to watch me or listen to me every day, Monday through Friday, 10 a.m. to noon, on schiffradio.com. Bye for now.